All right, so class, good morning, and you are welcome to our continuing lecture on financial accounting. Now, so far, we've gone through the basic of accounting, so we've been able to do the basics, and what we've done is to also go through, so in the basic, what we did was to define the accounting concept. Then we went on to talk about the accounting equation. And I know by now you can write the first accounting equation and the second accounting equation. So the first accounting equation goes like asset is equal to equity plus liability, or you can also say capital plus liability. The second one went like equity is equal to what? Asset minus liability. So this is what we've been doing. All right. But when we started the concept of accounting, we talked about the accounting process. It was part of the definition of accounting. All right. So we spoke about the accounting process. Now, if you really want to be a good accountant, this is the process that you go through. All right. So if you are studying accounting, you must understand the process. If you remember, we started saying that accounting is the process of recording, if you remember. So when we defined the accounting, the first thing we talked about was the process of recording, and that is what we are going to look at now. Yes, so we are going to learn how to record. But before you can record something, somebody must give you a document. For example, if I say I want to record a vehicle that I've bought for 10,000, then to be able to record a transaction, I will need something. What do I need? I will need the invoice. All right, because what you are posting into your books must have a source documentation. There has to be what we call a proof, the reason why you are posting something. All right, so if I go and I say I bought this pen, let's say 500 Ghana cedis. What is the proof that I bought this pen? And if I want to enter this into my financial statement, how do I go about it? What is the proof that I actually bought this pen? Well, the proof is there are so many processes that go through, but the ultimate one you can see now is that I bought a pen, I paid, I have receipt, and I have an invoice to that. So let's say if you go to a restaurant, all right, and you want to buy food, I mean, you go there, you make your order, you understand. So that is what you go there. So let's take the restaurant situation, and that is what I want to use. So when you go to a restaurant, what do? Maybe you and your friends, you go, you sit down. All right. The moment you sit down, what you see is what? The menu. Is that not it? All right. You go there, you see the menu. Now you look at the menu and place your order. So from the menu, what do? You place order. All right. Now when you place the order, the waiter or the waitress will come to you. And when he or she comes to you, he takes your order and he too will make the request at the cookery. All right. So once she does that, what do? You receive your food. All right. So you receive receipt of meal. So you get your composed food. All right. So when you get it, what do? Of course, you chop down with it. You eat. After eating, what happens? They give you a bill. And what do? You pay. So have you seen the processes? All right. So these are some of the things that happen. It happens so in accounting. Now you see all these things that you have done. Sitting down is not an accounting transaction. There's nothing to record. Taking the menu has nothing to record. Placing an order, yeah, you get some notes, but it's not something that you record. You receive your meal, it's not something you record. You chop, we don't record chopping. Then you receive your bill. This is where the process starts. Receiving the bill and paying the bill. Because at the time you receive the bill, it means you are owing. All right. And at that time here you pay, it means what? A cash transaction has been done. So this is where everything happens. All right. So this is what we are going to learn. So we are going to pick up and study. The first thing in the process here when you want to record is to get the document on which you base your recording on, and that is what we call the source document. All right, that is what we call the source document. Now, once we undergo the study of the source document, the next thing we will do, so if I get the bill, it is the point, the basis for me to make the payment. So if I get the bill, I'm now coming to make payment. All right. So you will need the source document. The source document, therefore, is the bill. You based on the bill to make what? Payments. All right. So that is what happens. So we are going to learn the various source of source document because we will need it. We will need it in our next lecture when we want to go deeper and do the books of prime entry. All right, so we want to know the source document. Then based on the source document, we will record those things in our book of prime entry. We also call them the day books. You can call them the journal or the books of original or books of first entry. Is the same thing. All right. Then when we finish the book of original entry or the prime entry, then the next thing we are going to do is to translate those things in the book of prime entry into a ledger. All right, so we will learn the components of the ledger. We will learn what the ledger account is, some chart of ledger account. Then when we finish everything in the ledger account, we will start dealing with how we will prepare our trial balance. All right, so we will go into how to prepare a trial balance, and then we will use the trial balance to prepare a P&L and a balance sheet. So that is the process. All right, if you're able to go through all this process, then it means that you are becoming a good accountant. Because preparing a financial statement can be a financial statement of a non-profit making organization. It can be a financial statement of a sole trader. It can be for a partner. It can be for a company. All right. So that is that. And you see the single entry and correction of errors are all inside the preparation of a financial statement. So it's a very simple act. But today, the first thing we want to learn is to learn the definitions of the source document, because these are theoretical things in your quizzes and in your exams you need to be ready for. All right. So now let's go into the source document. So what we're going to do is to know the source document, their content, and their purposes. All right. So just a quick one. So like you go to sit at the restaurant and you sit down, you request for the menu. There is something we call quotation. All right, quotation. Now, what is a quotation? In fact, the purpose of a quotation is to actually find out from various suppliers who have the things that you want to buy. So in business, if you want to buy something, we say that you invite quotation. Have you heard of the word tender before? People tender to you. They bring you documents to say that, yes, we have what you want and we are ready to supply you. All right. So the purpose for it is to actually know the prices of the various suppliers so that you can cross-reference and pick the right one. So you want to pick the one that is cheap but quality and effective. You will need to compare. So let's just take it like you going to the market. All right. So when you go to the market, let's say you go to Circle or you go to Ashama market, I live in Tema, so you go to Tema market. All right. Then when you want to buy tomatoes. Now, if you want to buy tomatoes, one thing we were taught back in the home is that you don't go to the market and buy from the first person you see. No, you don't do that. So what you do is that if I want to buy tomatoes, I'll go to the market woman B, market woman A, market woman B, market woman C, then market woman D. All right. So when I come here, all right, so I'll ask for the price. Because I know the quantity, I'll ask for the price. It's either you are buying a Ghanaian tomato or you are buying the Burkina one. So it depends on you. So you pick your own quantity, the description of what you want, it is in your head. You ask this one too for the price. You ask this one for the price. And you ask this one for the price. So you ask the first one for the price and say, okay, I'm coming. You go to the next one, ask for the price. So you realize that in between these four, there will be one whose tomatoes are hard, like strong, all right, like the Burkina tomatoes, all right. Then the price is also cheap. So you select that one. So that is what we call quotation. You are getting quotes, all right. But in business office, you rather sit in the comfort of your office and you will invite them. So they will be bringing them to you because every business wants to sell. So you sit in your chair and say, bring me. like the way you go to the restaurant and sit down and say, let the people bring it to you, menu to you. So that is how it is. All right. So the purpose is to check which price is lower, but quality so that you can buy. Now, once you get that, once you get the quotation, so let's say the quotation can be referenced to the menu. All right. The menu at the restaurant. So once you get the quotation, now you know the things that you want and you know who can give you the correct price. Then you place your order. So purchases order. All right. So what is an order? So the order, after you've checked all the prices, you feel like, okay, let me go to customer or supplier A to actually buy from. So what you do is that you will list the details, all right, the name or the name, the quantity of goods that you want to buy, the required price, and everything. All right. So once you have done that, you will now send it to your supplier for him to cross-check with the quotation they sent to you, that if they have it in availability to supply you. All right. So that is what you will do. Okay. So this one is like you going through the menu to make your selection, kind of. All right. So just the same thing. All right. So now you tell the person that, okay, I want I want this, I want that, I want this sandwich, I want this jollof rice with sauce, or which what do we call it, assorted fried rice, or whichever one you want. All right. So that is that. Anyway, so once you do that, you have actually sent the document to the supplier to verify what he has and what he's able to, supply you. All right. So that is that. The reverse is the sales order. All right, sales order. So here you see the purchase order is in respect of the supplier. The sales order is in respect of a customer. So the same thing, you cross-check details of order placed by a customer. So this one, you are not sending the order to a supplier. You are rather receiving from a supplier or a customer. All right. So you are rather receiving from a customer to be able to deliver goods to him. All right. So that is that. Now, when you make a purchase order and the people bring you the goods that they bring, all right, is coming with what we call a goods delivery note. So that is that. So that is what it is coming with. So this one, as you can see, it is provided by the supplier. All right, checked with the goods received and the order that you have placed. So that is what happens. So here you see that it has the details of the supplier, all right, and the address and the quantity. So we call it the goods delivery note. So it will come with what do we call it? The delivery that the supplier is making, the vehicle that they did. Sometimes we call it the way bill. All right. So way bill. So we are talking about the goods delivery note or the way bill. All right. So it will come with it. So once you have received the goods, so this is it. All right. Once you receive, you will now issue what we call goods received notes. All right. So that is a proof that you have actually received the goods. All right. So that is that. That is that. So the supplier will add a way bill or a goods delivery note. Then this one, the company that is receiving, all right, after comparing everything that you ordered against what you are actually getting, if it is the same, then everything is fine. You issue what? A goods receipt note, just to confirm that you have received the goods. All right. It doesn't really have the price in it. No, it doesn't have the price. It is the goods and the description of the goods, what you ordered. It doesn't have price in it. So never be misled about objective questions or about some essay questions when it comes to the fact that whether the price of the goods is inside the delivery note. No, we don't put prices in delivery note. Now, what we put in there is the quantity and the description. So whatever you ordered, if I ordered a shoe, then it means that if it is a Gucci shoe, then it means a Gucci shoe is what is coming. It is the shoe. If it is the shoe that is made by my friends in Kumasi, then that is the same thing. So you cross check. all right, everything, then you will now issue what we call a goods receipt note. Remember, very soon we will be talking about this one. We will be going deeper into this one, these two. Yes, very soon. So these are the ones that you don't want to let go of. You really want to actually have an understanding of that. Very, very important. Goods delivery note, goods receipt note. All right. So that is that. Then the next thing that happens is the invoice. All right. So you have now received your good receipts. You have confirmed that you have received it. The next thing you will hear from the supplier about is the invoice. Now, this invoice is the one that has the price. So it has the description of the goods that you bought, the quantity, the price per unit, and the total amount. All right. So that is that. So you see, and the terms of payment is also there. The credit days you have, how you will be paying. So these are the characteristics of an invoice. I remember when I started a job in one of the companies in Tema, fresh start. That's the first thing I was taught. That being in the finance department, when somebody brings an invoice, you must cross-check to verify if the invoice is correct. So you must check all these things, especially the payment terms and the terms of credit. All right. You also have to be very, very careful about the unit price and multiply it to confirm, because some of them, they can say that the quantity is, let's say, 10,000 and say that the price is, let's say, 5. But in writing 50,000, they write 60,000. So just so if you don't see, then it means you have overpaid. That is it. So you cross-check to see your total. All right. It's very, very important. Very soon you'll be going out there as somebody who is starting job in a finance department for the very first time. These are things that are asked in your interview, and these are things that you check. All right. So be careful. Then we have credit note. Now, a credit note, as you can see, is issued by the supplier. So what it is checked with the document regarding the goods that you have returned. So let's say you buy from someone on credit. Let's say bought goods 5,000 on credit from Ama Limited. What is your double entry? You bought goods, so goods is coming in. Is that not it? Very soon we'll be learning all these things when we get to the ledger. All right. So you have bought goods and you bought it on credit. So what is happening? What you see in there, the two things that you see in there, don't forget in accounting, there's always two things. So what do you see there? Goods is coming in. You bought goods, but you have not paid, and so you have a creditor. Now, the name of the creditor is Ama Limited. You owe Ama Limited. Why? Because you bought the goods on credit. So remember, goods are also what we call stock or inventory, all right? And where does it fall in the accounting equation? The A is equal to C plus L or E plus L. Where do you think that one falls under? Good. It's a resource owned by the entity. But who provided it? It was a creditor, which is a liability. This one is capital. So let me just make it equity so that you don't confuse C with C. So you will see that you have a liability who is a creditor, all right, who is Ama Limited. So this is it. All right. So what do you do? Since this one is an asset is increasing and liability is also increasing. When this side is increasing, what do you do? So you will debit. All right. You debit your stock of how much? 5,000. You will credit your creditor, Ama Limited. So Ama Limited also 5,000. Later on, you understand that this is what we call a journal. All right. So that is that. All right. So that is what has happened. Now, let's say that some of the goods you didn't like, you took it back. All right. You took it back to the creditor. So you see here that what you can see here is that it is issued by the supplier. all right, this one is issued by the supplier. So let's say that this AMA Limited is the one that we bought from. In the books of AMA Limited will say that, so we are the company, we bought, this is our accounting record. This is our accounting record. But for AMA Limited, what he has is that he has somebody who owes her. So that is we, the company, owing her. So in her books, it is called receivables. So in our books, it is called payable, creditor. In her books, it will be called receivable. So he wants to collect money from us. He has the right to receive money from us. Now, when we return some of the goods, okay, it means that it looks as if we have paid something, but it is not. We are just returning some of the goods. So what is going to happen is that here, our goods stock is going to decrease because we have returned some of the goods. And at the same time, our creditor is going to also what? Decrease because we have returned some of the goods. So now, in the books of AMA Limited, where he thinks he has made the sales, all right, so for her, she did a debit, so receivables, all right, and she has a credit, all right. So the credit that she has is the sales that she has done. So this is what she did. She has 5,000 to receive from us. So this is in the books of AMA, not in our company. This is AMA Limited company. So she has sold, she's expecting 5,000. Now, when we return some of the goods, it is going to reduce this figure. Now, in accounting, if you want to reduce a figure, you put it at the opposite side. So you see that since this one is a debit and we want to reduce it, we will put it at the opposite side, which is a credit. So this is what we call a credit note. Credit note is given by the supplier to confirm that he has actually reduced the amount that we have to pay him because what? We return some of the goods. So that is what it is, a credit note. Mind you, it is issued by the supplier. And please, you have to be very, very careful with these two terms: credit note, debit note, credit note, debit note, credit note, debit note. So that is that. Remember, a credit note is issued by the supplier, but a debit note is issued by the company who is receiving the goods. All right, so that is what will happen. Now, you see, we have a sales invoice, all right? So like the purchases invoice, we have the sales invoice. When you sell, you give somebody an invoice, all right? I think we all know about that. That is normal. But the debit note, all right, the debit note here is also that this is what is going to happen. So this is also contains the details of goods that your customer has returned, not you returning to your supplier, but the one the customer has what? Returned. So get to know that. So it is issued by the company receiving the goods. So the customer who was receiving the goods issues that. Now what you do is that you cross-reference the thing to the credit note. All right, issued by, it's just like that. It's cross-referred to that. All right, it's just the opposite. All right, that's why we call it cross-referred. It's just the opposite. So now if I sell, so like this time I sold to a customer on credit. Now it means that I will do what? I will do receivables like AMA Limited did. Then I will do a credit. All right. So the credit is my sales. So that is what has happened. So if here is 5,000, let's say here is 5,000. All right. Now, when I sold, it was somebody who was supposed to receive the goods. Now, so what is happening is that I have sold, the person is supposed to receive. Now, when he receives, I give the person invoice and I do this. But when she returns some of the goods, all right, it means that what has happened is that I need to now reduce my sales. All right, because I didn't actually sell everything. The person has actually brought some. All right, so that is that. So it is issued by the receiving company to the company who sold the thing. So it is the reverse of the credit note. All right, the credit note, what the credit note is doing, sometimes you can use a credit, the credit note is like a reduction. All right, the person who supply gives that. So he will give you, so let's say a discount. The discount can be in the form of a credit note, because it is reducing the amount that you have to pay. All right, so basically that is that. All right, so that is the understanding you need to get. One is issued by the supplier, the other one is issued by the company receiving the goods. All right, so take note of that. Of course, after everything is settled, what do? You bought goods. So when every payment is done, there has to be a payment advice. That is what we call the receipt. All right. If I have paid you and I've paid money into your bank account, so let's say, and that is what you later on realize that it will bring us some reconciliation. You will learn something called bank reconciliation. Because when I sold the thing to the person is paying me, the person paid to my bank account. Now, how do I know who paid me? Of course, I'll see it in the bank statement, but I need an advice. So let's say the person paid 4,000. What then will happen? Will I know that it was the 5,000 sales I did that has been paid? No, I wouldn't know. And even if I know that you have short paid me. So what is going to happen is that you have to send me a payment advice that you have paid me. All right. So this one is sent to the supplier. A customer sends to the supplier that supplier, I have paid you. All right. So that is that the bank account that I paid in is this, and these are the goods I paid for. Then lastly, what you do is that on monthly basis, you need to collect your statement, all right, and do reconciliation. Okay. So the supplier will send you your statement with them, like the way bankers send bank statements every month, so that you can do your internal reconciliation. So these are documents that you need to understand and go through. So these are the source documents. Now, in the next video, what we are going to do is to actually start the recording into the day books. So, my guess, what is a debit note? What is a credit note? What is a goods delivery note? And what is a goods receipt note? Get these four down because we will need it in our next video. Stay blessed. I'll see you in the next lecture. Bye-bye.